pursuits by Skoda. Only on Bloomberg Quint.
Thanks for joining us on lunch. This is Bloomberg Quint. I'm Harsha Subramaniam. The headlines at this hour. Markets gain momentum with benchmark indices trading at days highs. All sectors barring IT are trading in the green. Tata Motors is the top Nifty gainer after JLR posts a sharp jump in US sales. US President Donald Trump plans to end key trade preferences for India and Turkey. India's Commerce Secretary says there's room for negotiations. The trade war has already taken a toll on China, with the administration lowering GDP growth target to its lowest levels in nearly 3 decades. Thanks for joining in. We'll get to all of that in a moment, but quick check on how the markets have been faring. There is green on the screen today. Yatin is here with a closer look of some of those stocks that are moving. Yatin.
Good afternoon, Harsha. And if you look at the screen, it's look quite healthy, given the fact that even the mid-cap and the small-cap end of the market is participating in trade. Let's talk about the Nifty, which is almost 0.5% higher at this point in time, 51 points up on the Nifty. Advanced decline ratios are also quite healthy. We have 36 advances on the Nifty versus 14 declines. So good going as far as the entire market setup is concerned. Tata Motors, that is one stock which is in focus. We'll talk about it in detail, but that is up nearly 7%. India-U.S. Housing Finance, HPCL, Eicher Motors, Hero MotoCorp, all of these stocks are in focus, gaining anywhere between 3.5% to 6.5%. In fact, the auto pack is clearly under focus. And despite the fact that the month of February has not that been great, auto stocks have seen some bounce back from the recent lows. What's not doing well is the entire IT pack. So we have Tech Mahindra, Wipro, as well as Infosys, which feature on the top loser list as far as the Nifty 50 is concerned. So all of these stocks are, quite weak in trade. However, some small and mid-cap companies like Suzlon, Reliance Power, JP Associates, PNB, all of these beaten down names are doing anywhere, positive between 6.5% to 8.5%. So good gains coming in as far as all of these mid-cap names are concerned.
Nathan, thank you so much for that. But let's shift focus to the top story right now. Donald Trump is shifting his focus from China to India and Turkey when it comes to trade. The US president plans to end trade preferences to two countries in a move to counter what he calls unfair trade practices. But India's Commerce Secretary Anup Badhavan has assured the domestic industry that there's still room for negotiation. Listen in.
We were able to work out a very, very extensive and reasonable and meaningful package, which covered, I think, almost all the US concerns. Of course, there were some additional requests beyond that which could not be accepted at this time, and we conveyed to the US that what we have on the table that is mutually agreed is extremely meaningful and very extensive, and that could have been the basis for concluding our discussions on very meaningful terms. And then, of course, issues remain open for discussion always in the future. Nothing goes off the table. Even difficult issues continue getting discussed. So that was our view, but as you know, it has turned out somewhat differently. And let me also mention, to put things in very exact perspective, that our total GSP benefits were to the tune of $190 million on a trade of $5.6 billion. So the benefits, both in an absolute sense and as a percentage of the trade involved, are very, very minimal and moderate.
Okay, that's the Commerce Secretary. But let's talk about this a little in detail. We're joined by Raj Bhalla. He's the Brian Hyson Distinguished Professor at Kansas University, School of Law, and columnist for Bloomberg Quint. Professor Bhalla, thank you so much for joining us today. What's your mind are the implications of this move on India? This is an intention at this juncture, but will this have serious ramifications on Indo-US trade?
My pleasure. Thank you for having me. No, the Commerce Secretary is correct in saying that there really is somewhere between 190 million and 250 million US dollars worth of tariff savings that Indian exporters get by receiving GSP treatment. So it's not a hugely commercially significant tariff savings. But on the other hand, it is a significant change in the tone of the trade relationship, because for the first time, or an unusual time, the United States is using the GSP system as leverage to try and compel, if you will, reforms to the dairy sector, the medical device sector, e-commerce rules, and an array of other tariff and non-tariff barrier concerns that the U.S. has about India. This should not be a surprise to India or to the Modi administration. The GSP review of India was launched almost a year ago, in April of 2018. India has long known, the Modi administration has long known, that it's under review. And it's known that it's under review for exactly these sectors, like dairy and medical devices. And the U.S. has made very clear its concerns about e-commerce rules, data localization requirements, effects on Amazon and Flipkart. Again, no surprises here. And the president has said all along, since his inauguration speech, that his general feeling is that other countries have been long taking advantage of the United States, whether it's tariff benefits or other areas of trade. So I'm not defending the U.S. position, but I am saying it is completely understandable, and it was foreseeable by the Modi administration.
Mr. Bhalla, specifically on those two issues of dairy products and of medical equipment devices, where there seems to be the bone of contention, do you think there is scope for renegotiation on India's side, where there's some possibility of give and take?
Yes, absolutely. A good precedent that the trade negotiators, the trade team on the Indian side would look at, would be the new NAFTA and the Trans-Pacific Partnership, because both the new NAFTA and the Trans-Pacific Partnership have specific provisions on dairy market access and on medical devices. For example, there's an entire annex to the TBT, the Technical Barriers to Trade chapter, in the Trans-Pacific Partnership on medical devices. And dairy market access and quotas for dairy products were also dealt with in both the new NAFTA and TPP. So if I were a trade negotiator sitting in Delhi, I'd be looking at what did the Americans want and agree to in those two FTAs, and that's what I would be thinking about providing to the U.S. to satisfy the U.S. concerns in the GSP context.
Mr. Bhalla, I also want to know what you thought about the timing of this move, coming as it does when there is heightened tensions between India and Pakistan, and we are just a few weeks away from general elections. Does that read more than the move per se on what this means for Indo-U.S. relations at a slightly broader headline level?
Yes, perhaps. I mean, the timing of a lot of trade moves is really dictated by U.S. statutes. For example, on the Section 232 auto case, the president is in the 90-day window to make a decision, having gotten the report. Likewise, with GSP, he gets a report. He's got a period of time to make a decision. Now, that happens to coincide, unfortunately for India, and the Modi administration, with the Pakistan crisis and the elections. I wouldn't necessarily say that there's some deep-seated, carefully orchestrated conspiracy in Washington to try and put pressure on multiple fronts on South Bloc. I don't think it's quite that sinister. I think it just is somewhat coincidental on the timing. That said, from Washington's perspective, it's not bad to be pressuring the Modi administration when it is somewhat vulnerable coming up into the May elections.
Raj Bhalla, pleasure. Thank you so much indeed for joining us with your perspective. That's a view from Raj Bhalla, professor, and who's been looking at trade negotiations or trade talks between India and in the United States quite closely. But let's get you another view. This is the Indian industry body FICCI that has expressed concerns that the withdrawal of duty benefits will make businesses less competitive. Nikunj Ohri caught up with Sandeep Somani, president of FICCI, for this point of view.
I think on the liquidity, the RBI Governor, Mr. Das, is aware of it, and he's doing a lot to make sure that the liquidity crunch is removed, including a lot of OMOs that he has done. I think he has put more than 50,000 crores into the market. The Honorable Finance Minister is aware of the liquidity, I would not say crisis, but a crunch. And and he was quite confident in the next few weeks things will become better.
Okay, and on the tax?
And on the tax, we discussed corporate tax with him. As per his promise, he has reduced the corporate tax to 25% on companies up to a turnover of 250 crores. He was very hopeful that as the collections of GST increase, he will take a lenient view on the reducing of the tax for the larger size companies over a period of time.
Okay. And sir, another important development today has been withdrawal of duty benefits under the GSP, Generalized System of Preferences. So how do you see this impacting Indian businesses, and how will it hit competitiveness of Indian businesses?
So obviously it makes Indian business less competitive, but I am hopeful that the two governments will get into a closer dialogue with each other and this will not be implemented.
Continuing with trade talks, U.S. is nearing the finish line on a trade agreement with China. The deal, in fact, could be signed as early as this month. But that does not mean that the trade war is over. On one hand, China wants $200 billion worth of tariff immediately removed as it starts to hurt its economy. And on the other, the U.S. wants more to ensure that Beijing will follow through on its commitments. Andrew Brown of Bloomberg New Economy Forum talks about where things stand.
The Chinese really, really want these tariffs, $200 billion of tariffs, to go away for three reasons. First, it's a direct hit to Chinese growth. It's killing the private sector. Record levels of bankruptcies. You're seeing defaults on bonds. You're seeing job layoffs. You're seeing smaller pay increases, and in some cases, factories keeping workers at home and giving them a minimum wage. So that has led to a big blow to business confidence. Business confidence is right now about as bad as it's been in a generation since the early 1990s, and general disquiet in Chinese society about slowing growth. The Chinese are used to rip-roaring growth year after year. They've had it for the last 30, 40 decades. Finally, this is all leading to a questioning of the government's stewardship over the economy. And don't forget, it's economic stewardship that is the bedrock of its political legitimacy. And even you're starting to hear some muted criticism about Xi Jinping's leadership. Has he aggravated tensions with the United States? Does he know what he's doing in what has been essentially reversing years and years of reform and opening put in place by Deng Xiaoping? For all the reasons that the Chinese want the sanctions lifted or want the tariffs lifted, the hardliners, and I would count Lighthizer as one of those, but also figures like Steve Bannon in the background, are very reluctant to give up the tariffs lightly. You have to remember, for the last 20, 30 years, U.S. trade negotiators have gone to China as supplicants. Please, make some concession. And now they're going to say, hey guys, what have you got for us? Because they know that these tariffs are hurting. So how do you get rid of these? They see not just an opportunity, but a historic opportunity, and perhaps the last ever opportunity for leverage in order to extract the deep, meaningful concessions on structural changes in the Chinese economy that ultimately. So the question is Trump going to go for a deal which is going to give him a short-term boost, maybe lift those markets that aren't doing so well, and is he prepared to do that and sacrifice America's long-term trading and business interests?
All right, back home, Tata Motors is the top Nifty gainer today after JLR posted a sharp rise in its US sales over the extended weekend. Yatin's back with us with some good news for the company's shareholders. Yatin.
Well, clearly it is, and after we have seen muted quarterly performance, finally, some monthly data points to cheer about. If you look at the JLR sales, this time around in the US markets, they have seen a growth of nearly 29%, and they have posted the highest number of sales figures for the month of February as far as Jaguar is concerned, which saw a growth of 59% year on year. Not only that, Land Rover car sales stood at nearly 8,151 units, and that was again a growth of 19%. And this comes on the back of stronger, than ever sales versus its peer group. So you have luxury car makers like Porsche, BMW, Mercedes, Audi. All of these, companies have reported single-digit or a decline in the overall sales, wherein, JLR has seen a 29% growth, according to a Macquarie report. So clearly, when the luxury car market is shrinking, peers are not that doing well. JLR sales have jumped nearly 29% in, the US, and clearly the management also reiterating that the result is driven by the continuous sales momentum of the Discover Sport, Range Rover Sport, and Jaguar XE and F-Pace. So these are the few models which have done exceedingly well as far as the North American markets are concerned.
What about the broader industry?
Well, if you talk about the overall, marketplace for the domestic, players, the two-wheeler sales were not that great. But if you look at Tata Motors in the domestic market, there we have seen some bit of pain point, wherein the domestic sales for Tata Motors have declined because of the decline in truck sales as well as the commercial vehicle sales.
Okay. And two-wheelers in specific?
Two-wheelers, post the market hours last week, we had Hero MotoCorp, TVS Motors, as well as Royal Enfield reporting their numbers. The stocks are quite active, but all of them nearly missed the street expectations. In fact, if you look at Hero MotoCorp, the overall sales were down 2%, despite the fact that they had a muted, festive period, higher discounts, and the rural markets were about to pick up. There also we have not seen any pickup happen. Bajaj Auto, of course, the export markets lifted the overall numbers for them. Domestic two-wheeler sales growth was only 6%. If you talk about TVS Motors and Royal Enfield, there also we have seen a muted growth. In fact, if you look at Royal Enfield, again we have seen a decline in double digits for their overall domestic volumes. Clearly, the Chennai strike, weak demand in Kerala, and all of these other factors, including price hikes, have impacted sales for the two-wheeler players this time.
All right, Jonathan, thank you so much for that. That's the story on the automobile industry. Meanwhile, for Jet Airways, lessors continue to ground Jet Airways aircraft due to its failure to pay dues. Jet is now operating with a fleet that's shrunk by a fifth. That's in a little more than a month. Samit is standing by to tell us how bad the situation is and the impact that it's having on Jet's operations. Samit.
So if you see over the long weekend, Jet Airways has grounded nearly 6 additional aircrafts. Now with this, nearly 1/5 of the fleet has been grounded due to non-payments to lessor. Now if you see, the airline owned nearly 124 aircraft, of which 16 are owned by the company, and while the remaining are on lease. Now of this 124 aircraft, 25 have been grounded due to severe liquidity crunch that Jet Airways has been facing. Now the company said that they have been actively engaged with in talks with their lessors and have been providing them with the situation that they're seeing on the liquidity front. Along with that, they're also trying to minimize the disruption that will be caused to the network because of this grounding of aircrafts. But if you see over the last 1 month, nothing has improved for Jet Airways, and nearly 25 aircrafts have been grounded. Now if you see, as of 31st December, the company had a total gross debt of close to 7,600 crore rupees, of which the aircraft related debt was close to 1,600 crore rupees. And recently, Naresh Goyal led company also agreed to give lenders majority stake in the company in a move to turn around the stressed financials. So these are the developments that have been having with Jet Airways. Now grounding of these aircrafts, if you see, now that could help the industry and could also help the other aviation players, as it will not only free up some of the market share that would be available for the low cost carriers to grab in this domestic market, while lower numbers of aircraft that will be put up by Jet Airways could also lift the ticket prices in the domestic routes, because lower the number of aircrafts, lower will be the seats, and that could lift the ticket prices in the domestic aviation market. Now if you see, in the past, Jet Airways has been struggling to hold grounds in India in front of the low cost carriers like Indigo and SpiceJet. In the last 4 years, if you see, Jet Airways market share has nearly halved to close to around 13% from what it was around 26% 4 years back, and that is because of the stiff competition that the airline has seen from the low cost carriers. And with grounding of these aircrafts, the competition will get worse for Jet Airways going forward.
Shamit, thank you for that. That Jet Airways in the situation doesn't look great. Larsen & Toubro, meanwhile, has been struggling to achieve its targets in a few years. In fact, the company has been forced to cut its order inflow guidance for 5 years in a row. But fortunes may be turning for the country's largest infrastructure player. Not only has L&T maintained its guidance for this year, but there's also seems to be a good chance that it can actually exceed its projections this time. Darshan joins us to tell us why.
Yeah, so basically, if you're looking at it, we analyzed the last 6 years, commentary that the management gave, and at the start of the year they gave a guidance. The last 6 years they've always managed to cut it around because the orders were simply not coming in. This time it seems different. In FY14 they cut it to 15% from 20% in the third quarter, and this happens between the second and third quarter. FY15 they cut it in the second quarter. FY16, if you're looking at it, the numbers were weak. They actually cut it twice, from 15% to flat. FY17, FY18 also from 10% to 15%. FY18 was really bad. They cut it from a 12 to 14% guidance to a flat guidance. FY19 they maintained to manage the order inflow guidance at 10 to 12%, and in the first quarter they had said orders will be front-ended. So the expectation was that probably the second half won't be very strong, but the numbers that come out certainly seem to indicate that there seems to be a strong possibility that the numbers are extremely strong. Now in FY18 the order as per the press release was 1,52,918, what's something that they won. So for a 10% growth the target is 1,68,000. For a 12% growth, it is 1,71,000. The order still now is 1,20,000, which means potentially anywhere between 48,000 crores to 51,000 crores is something that they need to meet the order inflow guidance of 10 to 12%. So that is the math for it. Now, if you're looking at the order book and the total orders, what is important is the order. The first quarter was 36,000 crores, 42,000 crores, and then 42,000 crores. But historically, if you see that the fourth quarter is always the strongest because that's when majority of the orders are closed. So this number is expected to grow in significantly higher. What L&T has done is that they've stopped giving order, the exact amount of order from this quarter itself. They divided it into 4. So significant orders will be an order worth anywhere between 1,000 to 2,500 crores. Large, major, and mega. Mega is anything between above 7,000 crores. So it could be 8,000, 10,000, 15,000 crores. No one knows at this point of time. And these are all the indicative orders that they have said. Majority of the orders that they have actually come out are in the construction and hydrocarbon space. So from Feb 15, the airport construction order was a big order that they got. It was a mega order that they got, which was more than a 7,000 crore order that they got. Similarly, construction orders in power and building were significantly large orders and significant orders that they got. The other orders that they got was the big Algeria order of over 7,000 crores. There was a mega order that came in. Again, water supply, IOC, 2 projects from IOC that came in. They didn't give the order amount. The hydrocarbon. The last order that they declared was a Jan 3rd order. Was the BharatNet order of 1,060 crores. So what you have to do now is to assume, take a midpoint and a median of all these orders to come out. Now, according to the calculations that we've done, anywhere between 21,000 crores to 30,000 crores would be the ideal order that they would have won as far as the third quarter is concerned. This is the minimum order. The median would be anywhere between 25 to 27,000 crores. Credit Suisse indicates that it's close to 27,000 crores. So it's sizable orders that they've done, and they need to achieve close to 49,000 crores. So it seems with the orders, the slow orders, that they may be able to achieve it.
Interesting. What's the market saying? Are brokers optimistic too?
Yeah, so basically Credit Suisse is saying that the order inflow of fourth quarter, what they've already announced, including the smaller orders which they have not announced, could be 40,000 crores. Today also they won an order that came in. So high chance that they will go move in close to the 50,000 crore mark. So they are saying it could be 40,000 crores. They've done 27,000 crores according to Credit Suisse in this quarter itself. Bank of America Merrill Lynch is very positive. They are saying that the high earning visibility and strong book-to-bill ratio of 2.6 times is extremely strong. Morgan Stanley's come out with a note. They are positive. They are saying that the momentum in the fourth quarter appears strong. So in most cases, as per the median calculation, because we don't have the exact number because L&T doesn't give them, it seems that after failing for so many years, not failing in type cutting orders, this time around maintaining the orders and meeting that order inflow guidance probably will be a reality for L&T this time.
Darshan, thank you for that. That's L&T for you. Former Finance Minister P. Chidambaram, meanwhile, has criticized the implementation of GST and its design. He says that 2 central ideas of the tax regime have been thrown out of the window by the NDA government. Speaking at a panel after the release of his book, Undaunted, Saving the Idea of India, this is what he had to say. Listen.
Close on the heels of demonetization, they implemented a flawed GST. The design was flawed. The implementation was flawed.
GST was a Congress idea.
The Congress idea, but the design was not ours. That is not our design. In fact, you go back and read my speech in Parliament. I said, what is this? This is not GST. Call it by any other name. My president gave it a name, but I didn't give that name. I said, call it any other name. Why do you call it GST? This is not GST. GST, what are the two central ideas of a GST? One, it is a single rate. With whatever you don't want taxed, zero rated. It's a single rate. And second, it is a non-cascading tax, which means there must always be input tax credit and output tax liability. Now you've distorted both. You've distorted both by having multiple rates, and you're now removing input tax credit in many, many areas. If you remove input tax credit, we go back to the old cascading regime of sales tax, isn't it? I mean, the two central ideas of a GST have been thrown out of the window.
So you're going to have only one slab.
It'll be one rate, and one rate means what Dr. Arvind Subramaniam said. Yeah. It'll be in the transition period, a standard rate minus, standard rate, and a standard rate plus. But that's a transition. Eventually, it'll be one rate.
But Mr. Chidambaram,
I know it's difficult for people to accept it. They come back with this argument, which the finance minister comes back. Can Mercedes-Benz be taxed in the same way as something else?
That's not.
I mean, that's a hackneyed argument. That's not an argument. If you don't want GST, say so and go back to the old system. But if you want GST, everything, there must be one standard rate.
What would that rate be?
It will be a rate which more or less approximate to what Arvind Subramaniam's report said.
Which was?
He said 14.5, 15. It could be lower if there's greater compliance.
It's the former Finance Minister P. Chidambaram. In a giant leap in healthcare, a man in London has reportedly been cured of HIV. He's the only second known adult cleared of the fatal virus. Take a look. Out of time on the show. Thank you so much for joining us on lunch today. Keep watching Bloomberg Quint.